Hey guys, and welcome back to the channel. Make sure you're liking, subscribing, and leave a comment so I know more of the content that I can bring to you. Now, of course, you're banking with Rob, so I want to dive straight into it. We're going to get straight into what I like to call the meat and potatoes. Okay, so the cost basis of the policy and understanding what that is. You put in a premium deposit into your policy, and that premium deposit buys you a death benefit, and from that death benefit we get cash value. Okay, so this cash value cup is a representation of how much we can spend from our death benefit at that point in time inside of our lives, because we're not dead. Only dead people need death benefits. You are not dead, you are alive, or you wouldn't be watching this video. So with that being said, is you're going to take a loan and collateralize that death benefit. That is the cash value, the living value of that policy, and that's what we're able to do our banking with. Okay, the cost basis is the premiums that started all of what I just explained. So before any of that happens, you have to put in a premium deposit, and when you put that premium deposit into your policy, that's what buys you the death benefit. From the death benefit, we get liquidity, which is the collateralized amount of money that we can use against that death benefit at this point in time in our lives. That is the cash value. The cost basis of our policies, once again, being the premium deposits. If we're taking a loan against our policy and not a withdrawal, that means that the premium deposits are still within our policy, our cost basis. Okay, so over the span of our policy, and just to preference this, we do suggest that you don't take advantage of this strategy for at least 20 years, because you need your policy to build and grow. And of course, you want to be able to take value out of that policy and extract more than what you put in. But more importantly, what about the loved ones and the people that you have left over after the fact, right? So what we want to do is we want to build our policy up. We want to take the cost basis, which is all the premiums that we've ever put into this policy. We want to be able to take that back out plus more, okay, and still leave our family a legacy once we're gone. So that is what the cost basis is. The cost basis is the dollars that we've deposited into premium over the course of our policy. And by taking that cost basis and only taking the cost basis, okay, only taking the dollars that we deposited, there's no taxes to be filed. Okay, we don't have to pay any taxes. All right. And why? Because if you bought something from Walmart and you returned it to Walmart or any other store with that receipt, did you make a gain on that? No. You just exchange the value back. Okay, I got the wrong shirt, I got the wrong size, right? I'm going to exchange it back for those dollars, but I didn't actually gain anything inside that transaction. Now, they might even give you a store credit. The store credit is still the same thing. It's saying, okay, we're going to take this thing of value back. We're going to give you this credit to then apply to something else of equal value. But there wasn't any gain that actually happened in there. Same thing with our policy. If I deposit $10,000 for 20 years, I will have $200,000, which is roughly exactly what the average American will have for retirement when they do retire. $200,000 is what I could take out of that policy completely tax free. That's something that we don't see with other retirement accounts like IRAs and 401ks. So we'll be able to take back all the dollars that we've ever put into that policy and get those dollars back to us while still having cash value inside of that policy. And we'll still have our death benefit to leave our family whenever it is we pass away. So for an example, if you have $1 million death benefit and you put in $300,000 inside of premiums, you could take the $300,000 back, which is subtracted from what? The death benefit, right? So that's going to leave you $700,000 left inside that death benefit. But from that death benefit at that time, let's say that you have another $200,000 inside of cash value. You could take that as well. So you could always borrow tax-free against that cash value that's there. You have $200,000 of the $700,000 that's left over that can be collateralized, and that's liquidity within the policy. I could take out that $200,000 from my policy and leave $500,000 to my family whenever it is I pass away, which is above and beyond what most people are leaving their families when they do pass away. So not only could I have an above average retirement, I also can leave more money than what the average American will leave their family whenever it is that they do leave this earth. Okay, so think about it. What are you doing with your cash? Where are you banking? Where are you putting your dollars? And what are they doing for you? Because here you can get your dollars back, everything that you've ever put into it, back completely tax free. And you can leave your family a legacy while also ensuring your retirement. It's a better way to do money. It's a better way to bank. So what are you doing? How are you doing it? And why haven't you guys started with becoming your own bank?